The biggest problem that I have when I start talking to people about insurance, if they've done a lot of research on YouTube University, is there's a lot of bad math out there. And I think as advisors, we need to be very accurate on the math and tell the truth.
Hey, here's your savings account. The first 3 years you put money in, nothing happens. We keep it all. After that, it makes 1.2%. And when you die, you lose your money. No one would put money in
I
that.
agree.
That's fair.
That's a whole life policy. So nobody ought to put money in a whole life policy.
95% of how people sell whole life or IUL is something that we actively call people out on. There's probably people in the life insurance industry that hate us more than people that are not in our space because we're exposing them on the BS. All right, guys, the time has come. We're going to be reacting to 5 videos that the team has whipped together. And I think some are going to be pro-life insurance. Some are going to be very anti-life insurance. I know that because we have a Dave Ramsey video in there. And then there's a couple other people that I've recognized. We got Dom. We got Demetrius. We got Alden. And we're in the BetterWealth studio. And we've done reactions. But I don't think we've ever done a 4-person in-person reaction. And I can't wait. So to knock this thing off, we got our boy Kris Krohn. And never seen this video. But let's tee it up and see what he got to say.
Get a whole life insurance policy. I'm not talking about insurance to invest in your death or for your loved ones to get some money when you die. I just do term insurance for that. But I'm talking about whole life. And what whole life means is I can take every month my leftover money and I can put it into an insurance policy that I can access. It's a high value early cash out policy. Write that down. It's a special type of policy that your average insurance broker will not pitch you to. They don't make a whole lot of commission pushing this product, but it's very intelligent for you. So every month I roll and write a massive check, automatically debits out of my account, and it will go into my whole life policy. I can borrow this money, I can use it, I can bank it, but in the meantime, it's growing at 6 or 7%. It's also untouchable.
I feel like...
Which company is he with?
No, what did he say? He's like, it's a high cash value. Like he just
high
took
cash out policy.
He used all the keywords, put it together. Yeah,
It's his own special product.
So he's getting 6 and 7%.
Here's my thing, Chris. If you're watching this, I would love to see your policies. Like let's do something. Let's see what you have, because I'm sure he's doing this. I just don't know how much. You know how some people get maybe a name about themselves that they overhype something or overpitch something or maybe over-exaggerate. Mm-hmm. Sometimes I get the sense that he does that in a lot of different areas, but it is really cool that he's a fan of this, and I'm sure he has it. I would be really curious to see how he actually uses it.
What was the part that you feel like he overhyped?
That he writes massive checks to the insurance company every month. I just don't think that's what he actually does. I call cap on that, but I believe he has written massive checks, just not every month, to insurance companies that are high cash value. And I think he has probably used them for real estate. So I'm sure and I could be wrong. He might be doing it. That's just my initial reaction when he says that. I feel like you get less credibility when you say things like that because those of us that knows what's going on is like, are you? Maybe. But are you?
Yeah.
What's your guys' thoughts on the 6 and 7%?
I mean, in my high value cash out policy, I make 15. So
Not investment advice.
Not investment advice. Don't sue us. But it's funny because I think what he's exactly quoting is likely the declared dividend rate. And actually, now I said it out loud, I don't know any 7s. So maybe this is
to be fair, this was a while ago, I think. He looks a lot younger in that.
It's even worse.
So
I mean, it's either that or it's a tax equivalent yield or something like that is what he's trying. I'm not saying he's right. I'm just saying that could be what he's doing math in his head. Or
I think
I
it's
don't know.
misleading.
Yeah.
Yeah, it's misleading. I think part of the biggest problem that I have when I start talking to people about insurance, if they've done a lot of research on YouTube University, is there's a lot of bad math out there. Yeah. And I think as advisors, we need to be very accurate on the math and tell the truth. Now, Chris is an advisor, so I'm not going to throw him under that bus, but it's something that if we're going to be talking about this as insurance professionals, it has to be factual and it has to be accurate. If it's not, it's unethical, in my opinion.
I think from a marketing perspective, I think this conversation is very hard to describe the return on whole life in general. So I understand why he may have picked this number and said, this is the thing that I'm going to die on the sword with, right? But I think over time, we have tried to learn how to speak about it in a way that we feel proud about. And so some of the language that Caleb and I have used over time is like long-term And we use the word long-term because if you look at life insurance in general, the first year, we know it's a negative return, right? And so we say long-term, you can see roughly on a conservative side, close to 4% IRR. Because if you talk about IRR versus rate of return, depending on any year, it could be a lot different. Because your IRR could be very low early on, but realistically, when you put $1 in, there's a point in time, not that too long, where you're going to get $2 back, and it actually could be like 100% rate of return for dollar for cash on cash. So it's slightly different depending on what topic we're talking about. And, that's why it makes marketing very complicated. But for us, it feels very slimy, which we don't like.
Yeah. And I got to admit, I feel like sometimes when we use the term IRR, it's like we had to learn how to explain it ourselves. And then when we try to explain it to a consumer, especially for the first time, it's like people don't think of rate of return in the way that IRR is calculated.
Yeah.
And so that's just something that we have to take into account. People normally look at it from a cash on cash year to year perspective, which, depending on where you're at in the policy, maybe it's getting somewhere around 6%. But I wouldn't want to push that because IRR is a better metric in terms of total cash
the
in.
actual return.
Exactly. Total cash in versus how much do I have?
And to give Chris a little bit of benefit, you can say long term, if you have an internal rate of return of 4.5% or 5.5%,
Sure.
with a taxable equivalent, meaning like this, if you had to factor in taxes,
Sure.
if you had to factor in other things, that's where you could say life insurance gets a 6, 7, 8, 9, 10%.
Yeah.
The point that we're all making is it's just a slippery road.
Yeah.
And we know people that literally use the dividend rate because that's what he really is doing.
Yeah.
He's looking at the dividend, and that's just it. I don't love when people quote dividend. I feel like it's very misleading. It makes everybody look bad because the consumer, when you're hearing you're going to earn 7%, what do you hear? You're going to earn 7%.
Yeah.
And when you're not,
That's it.
it feels like you just lied to me. And they have a good point.
And then whole life becomes a scam.
Yeah.
It's like just tell it how it is, and people who want it will be attracted to it. People who don't will be repelled from it. That's fine. It's like the nature of marketing.
Okay, on to the next video.
Or if I start pitching you a savings account on TikTok and I said, hey, here's your savings account. The first 3 years you put money in, nothing happens. We keep it all. After that, it makes 1.2%. And when you die, you lose your money. No one would put money in that.
I agree.
That's fair.
That's a whole life policy. So nobody ought to put money in a whole life policy.
Kind of policy I think he done built, I mean, it's pretty apparent. It's like an all-base policy of what we would call it, right?
So I'm just going to start with, because I'm not going to get into the logistics of how life insurance works. I'm sure you guys will be better off suited with that. But what I would say is when we're listening to Dave and you listen to Chris, they're both using marketing, but in the opposite direction.
Yes.
And so Chris is over-fabricating what life insurance does, and Dave is under-fabricating what life insurance actually is.
Yeah.
Right.
That's absolutely true. And it's comical to me for a couple of reasons. There used to be a clip of Dave Ramsey on his show talking about his permanent life insurance policy. That got removed. It was about 5 years ago. And so I think there's an aspect to, I should say there's an aspect of truth to this that I think Dave is talking to his market. And his market needs to hear this, in his opinion. And like you're saying, it's a marketing thing. But to the design side of things, a whole life insurance policy averaging 1.2% return long term,
policy.
that's not a mutual company because the dividends would be kicking in, and it's way better than that long term.
Yeah, even if you designed it.
Even if you designed it with all base insurance, no paid up additions, no bells, no whistles. So I think in a vacuum, the statements that he's making could be true for a very, very small.
Well, can
subset
we
of
all
market.
agree if that was what in whole life insurance was, we wouldn't be selling it or owning it?
Be in a different career.
Yeah, I'm 100%. So what he said, nothing for the first 3 years, earns 1.2%, and then they steal all your money when you die.
Yeah.
That
I
sucks,
would
dude.
love to talk about that aspect of it as well.
But all three of those things could be refuted pretty clearly. Is it possible to have early cash value in the first 3 years? Yes.
Yeah.
Is it possible to get 400% greater return than what he's promoting on this in a life insurance policy? By the way, Dave, no risk.
Yeah.
You know what I'm saying? He's all about factoring in risk. And then, do they steal your money when you die?
No.
No.
Yeah.
And let's talk about this because they say you don't get the cash value. So why don't they steal your money when you die?
So this is a question I got a couple of days ago, actually, and we were looking at a policy where we're doing 10 years of payments. All right. In the first 10 years, the death benefit doubled. In the latter 30 years, it tripled. And so you're buying, in this, I don't remember the exact numbers, but let's say you're buying $100,000 of permanent life insurance. But because of the way it's structured and because of the company, that company ultimately grows your death benefit. And let's say it's $1 million by life expectancy. You're paying for $100,000, it grows to $1 million. The fact that there's cash value is a byproduct of a permanent life insurance policy. So your cash value in 20, 30 years could be $500,000. But your death benefit has also been pushed really, really high up. So of course, they're not going to give you both the death benefit to your beneficiaries and the cash value, because the cash value is the net present death benefit.
Yeah. But what if Alden, what if they would say, instead of increasing the death benefit, we're just going to pay you the initial death benefit plus your cash value? What would be better from a taxation standpoint? The death benefit? This is an easy thing. If I could get an income tax-free death benefit,
sure, or
I had my cash value, which then I would have to pay some type of tax on the gain, most likely.
You'd be dead. So,
but no, you hear what I'm saying. like there's a world where, whereas, so it's interesting that it's like what you're saying is the death benefit is will grow. Like it's really not, they're not stealing your money. Like I don't know why this is still a talking point. You actually get more money than what you've put in, but the fact that you don't get cash value, very much like the other side, they'll take a talking point and, in my humble opinion, misrepresent what's actually going on.
But to be fair, devil's advocate, you pull out an illustration, nobody that knows nothing about life insurance, and you look at it. All three of those can be true. You can design an all-base policy the first couple of years, no cash value. You essentially have an IRR that doesn't break even till years 7, 8, 10, 11, 12. That's still 0%.
Yeah.
Right? By year 14, 15, you may now get like 1% to 2%. And you ask the question, hey, do I get the cash value and the death benefit? The answer is no. So in theory, to Dave's point, if you look at it, the uneducated person would say Dave is correct.
Yeah.
Come work with us. The link's below if you want education or want to talk to someone that doesn't get you a policy like this. That's why we're in business, I guess. I don't know. All right, let's tee up this next one.
Some people are peddling whole life insurance like it's a good investment for everybody, but you know better because you follow me, Vivian, your rich BFF, your favorite Wall Street girly, who can break it down. There are two main types of insurance. Term life you're probably familiar with. You pay money so when you your family gets a little something something. Whole life also has this death benefit, but also has an investment component that allows its value to grow over time. And a lot of scammers on social media are selling whole life insurance, IULs, MPIs, whatever they want to call them, as a good investment for everyone. But in reality, these are only good investments for high net worth folks because the upfront fees are so high. In fact, MetLife determined that a 30-year-old male could pay $672 a year for 20 years of term life insurance and $8,320 a year for whole life insurance. For the average person, the upfront cost of whole life insurance would be better invested in the stock market. You'd see meaningfully higher returns. And for all the times that whole life was touted as this amazing investment, they miss one big caveat. It only makes sense if you already have a lot of money.
I mean, I got to give her flowers. She's incredible. Like, you're doing a good job. Good job. You're wrong, but you're doing a good job.
Well, I mean, she's not like all wrong from a standpoint of like, it's not like good for everyone per se. I will say she is wrong when she's like, it's only for quote unquote rich people or whatever she said there. And it seems like she was taking the standpoint of the death benefit specifically, because she was comparing the cost of death benefit. And it's like, well, it sure, if it just depends on what you're getting the policy for and how long you need it, and if you care about legacy and things of that nature. So
when you say she's wrong, what areas in the video was she wrong in?
Well, I think for the first part, when she's talking about the different types of life insurance, term life, whole life, and then within whole life, there's IUL, there's all these other buckets. There's many different types of permanent life insurance. Whole life is a singular product. Yeah. Beyond that, I think from a perspective of the death benefit coverage, right? Comparing term insurance to permanent insurance is, I think, a very wrong comparison, because one is guaranteed to pay out, period. The other one, you could think of it, I think I've seen another one of her videos where basically term insurance is you're still gambling on you dying, but it's a lot cheaper. Because you're gambling on when you're going to die as far as the death benefit being paid. Permanent life insurance is permanent. It's going to be there whenever you need it, as long as you pay your premiums. And so it's a huge difference in the value of those products. And so I think the juxtaposition just isn't fair.
Yeah, I honestly have a hard time watching TikTok videos now for this reason. And a lot of it has to do with, we were on Bobby Samuelson's podcast, and he was on ours and he came on the show. He said that people like you guys need to be on TikTok more because you guys need to fight the good fight, because there's too many TikTokers that are on there sharing information that just doesn't make sense. And so to all of the points, right, we could argue all day of like, this is good, not good, etc. The problem that I have with this is the lack of context. And essentially, she's doing black and white answers on what is true and what's not. She said that S&P 500 investing is better across the board, 100% for better people, like with a definitive answer. And we know that that is not correct based off of the individual and who they are, what they're trying to accomplish. If we give blanket advice across the board, you can get people into trouble, and at the end of the day, prevent people from actually showing up and living their one life.
Yeah, no, I agree with what you guys are saying. It's very interesting to me that she's making statements, and for the most part, I think we agree with these people more than we disagree, because that's what makes us different in this space. I mean, 95% of how people sell whole life or IUL is something that we actively call people out on. And that's why there's probably people in the life insurance industry that hate us more than people that are not in our space, because we're exposing them on their BS. And so I think the first and all, like sometimes we can almost make these people the quote unquote enemies, but I actually think it's like, actually, no, this is why we do what we're doing, because if life insurance is going to make sense, it can't look like that for obvious reasons, and that's why we're in business. So yeah, I think I really appreciate what she's up to, and even she said it doesn't make sense unless you have a lot of money. Could it actually be true? Because we have limits. What we say is, if you can't at least save $10,000 a year or more, this might not be right for you. Well, how many people in America can actually save more than $10,000? I mean, that tells you how privileged we are to even think like we're not wealthy, but we can save over $10,000 a year. Whereas most people aren't, and we would all tell them if they called in saying, Alden, I want life insurance, I want permanent life insurance, and we look at their situation, we wouldn't even sell them or let them buy it from us, because we wouldn't. So in a way, like, yeah, she might not agree with it. She might think like you need to be worth $100 million. I don't know she doesn't, say anything more here, but I think there's actually more that we agree. It just is unfortunate because these people have to make videos because there's such bad information out, and because we're nerds, and then we can be like, well, actually, if done properly, this is how it could be an asset. But if the problem is, if you don't have that asterisk, people are going to get peddled garbage. So there's my rich BFF, Vivian. I'm a fan of Vivian. I like that name.
Here's life insurance explained in 90 seconds using a third grade stick figure. All right, this is Don. Now, he makes $75,000 per year with his job, and he has a son named Kingston, a daughter named Snow. One's 2 years old, one's 8 months old, and he has a wife named Dana. She's 29 years old. Now, they have a mortgage of $600,000 and also a credit card debt of $5,000, a car note of $26,000, and ongoing living expenses of $40,000. Now, Don gets hit by a truck, and he dies unexpectedly. Extremely sad. Dana goes to the funeral director. His name is Fred. Fred, the funeral director, says, hey, it's going to cost $10,000 to bury Don. And she's like, what? I didn't even know it was this expensive. And on top of that, you still got the $600,000 mortgage. You still got the $26,000 car. And she has to figure out how to replace Don's salary of $75,000 per year. But Don was smart. Before he died, he bought a life insurance policy for $750,000. And guess what? Life insurance is tax-free. So Dana got $750,000.
Yeah, man. I first of all love the hustle, love the pictures.
Yeah.
I think it's a good example of how life insurance death benefit can be essential for growing your family.
I think if people have never understood how life insurance actually works and sees that picture, it's like, they start to put themselves potentially in that person's shoes. They may want to get themselves a $750,000 life insurance policy.
Yeah, I'm doing the math, and it's like I wish our boy Don
A little bit more.
got more life insurance.
Yeah.
That
Yeah,
could
well,
be.
let's walk through that math real quick. So if I can squint here, we got $600,000 of a mortgage. We got $26,000 car, and we're trying to also have to pay for burials, 10 grand. So right there, we got about 650,000, and then we're also trying to replace 1 year of income for his wife and his kids. That's the problem I have.
So let's break that down. So someone could look at that and say, Don, great job. Like you didn't leave your kid, you didn't leave your family in a burden.
Right.
But I think you would have a different take.
Yeah. So 2 takes. One, in this situation, they may have a paid off house, but they have no income. So they got to sell the house and move out anyway. Yeah. The other way is, okay, well, maybe they stay in the house. They take that $750,000 to pay the mortgage and their expenses just to kind of to get by. In my opinion, when I do planning, there's a couple of things that I want to see. If we're looking for a death benefit protection, I want to make sure that the kids at home can get into and out of high school without having a big financial problem, right? If something were to happen to the key breadwinner. Paying off existing debt, at the end of the day, when you're walking through the death of a loved one, death of a friend, those types of situations, you don't want to be really worried about money. You want to be able to just move on and take care of the situation you need to take care of. So in my opinion, this isn't enough death benefit protection based off his salary.
Yeah. I look at this, if we do the 4% rule, which is like a typical rule that people use in retirement planning, if he's earning $75,000 a year, and we're not assuming any inflation adjustment, that's a $1.8 million essentially. 1.8 million and 75,000 at a 4% rule would produce about 75 grand. And so, to your point, the criticism would be, what is more valuable, a paid off home or the actual ongoing salary? And if you're going to do proper life insurance protection, you should look at your current obligations. But then you also need to look at the asset, which is your life, which we can all agree that your ability to earn and create is your greatest asset.
100%.
And so that would be like, I love this example, and I love it a lot because it breaks down like the power of life insurance. And the only maybe tidbit that we could add is Don needs at least $1 more million on top of that. And then you could show how it pays their liabilities and supplements the income for a period of time.
So the question is whole life for this guy better?
I think it would depend on his cash flow, right? So if we're looking at a pure protection play, I think life insurance exists to protect families, preserve capital, and provide stability. It's something that Bobby Samuelson said. I think it's amazing. So from a protection standpoint, if what we're looking for is death benefit and to mitigate the risk of a passing, we can do that in the cheapest vehicle possible for the short amount of time possible. But what happens when that term is gone? Right.
Well, let's just say he has $10,000 of cash flow in this example. Should he have gotten whole life instead?
I think it's possible to consider whole life. And if our minimum's 10,000, that's what we're talking about. I think whole life could still be a great asset because I don't think, maybe they mentioned the age of the kids here. I missed it. But if you think about it, if you have the ability to save, let's say $10,000 a year from age 2 up until they're 20, that initial death benefit, if we're focusing on cash value, is probably going to be pretty small. But by the time that the kids are out of the house, now we have a much larger death benefit. And oh, by the way, we'd probably be able to pay for their college. So the cash value aspect is still very important. So I think
knowing what we know now, whatever gave him the most money when he got hit by that bus was going to be the best option. And if we were going to do whole life, I think it would be important to be like, well, we still need to hit that $1.8 million death benefit. So that would be like the thought process is like, let's get there, but let's play this out. Let's say he had $750,000 term. One, he did the buy term and invest a difference. Don, which Don do you want to die? Okay, this Don or the Don that does whole life, and you're automatically going to have more death benefit tied to it. So I think it's going to be like, it's not an either or, it's an and. But I think the real takeaway in this video is just because you have life insurance doesn't mean that it's the amount. And like maybe that's the call to action is get more life insurance maybe that's called that.
And was your question to Alden, like if they had $10,000 to put into life insurance? Is that what you asked?
Yeah, based off of cash flow, if you had $10,000 saved annually, should we put it into whole life or should we just get term, or what should be the solution? And I think what I've taken away from listening to everybody here is that, and what you really said at the end, which Don do you want to be, is you don't know. You only have one life, and it could be tomorrow. And so you have to prepare for today and also for the future. So the proper risk management accordingly makes the most sense, and looking at all the solutions and being able to talk to somebody who knows what they're doing, to ask the right questions really is important, because trying to do this alone, it becomes very complicated.
And I'll say this from a life insurance perspective. I think, us being in the life insurance world, I think it's oftentimes we want to talk about how much life insurance does one need. And I'm like, the necessity only comes into play after you have the conversation about what you would want from like a life perspective afterwards. Yeah, right. So it's like, hey, I want my income to be replaced for the next 15, 20, 30 years. Well, it may necessitate you getting enough coverage regardless of the type.
Unfortunately, most people do what I call sugar daddy planning. You pass away, your wife's got to find a sugar daddy. So the fact that he's got insurance
You
makes
said
me
that
really
on a
happy.
meeting the other day that really threw me for a curveball. I was like, I cannot believe Alden said that to that person, but good for him. So he's not just making that up, ladies and gentlemen. He actually says that in a meeting.
I mean, you have to think about it.
I don't know if it landed as well as you thought it would.
Well, it's funny though, because that's the other side of it. The spouse is like, well, I don't want to have this massive death benefit, because if I die, I don't want her to take all that money that I had and go run off with another sugar daddy anyway. So there's two sides to the coin.
Yeah, there's two sides. Always two sides.
I mean, there's legacy planning that you can do.
If you're insecure, you always find reasons not to do decisions.
Yeah. But to Demetrius' point too, you could put trust and other systems in place to help mitigate some of that if you really wanted to.
Yeah, if you get married, all this money goes away. That would be terrible. Don't do that.
What kind of planning is that?
All right.
Only 2% of term policies ever pay out. People think, well, life insurance companies make money on whole life. No, they make money on term, because you pay all that money in and you don't die in that term. Less than 2% of whole life policies pay out.
I've never heard that statistic. That's amazing.
I can sell term all day long and make more money than I make whole life.
Oh, Mary, don't do this to me.
Oh,
all right.
Such high expectations.
So I want to start by something, and it's something that I think actually would be a very good video that I would actually love to do some more research on and come back to it, is that Bobby Samuelson actually did in a very intensive blog and intensive research sharing that the 2% of payouts on term insurance is actually a myth. And it's just one of those things that just gets shared in the industry, right? And so just a future layup, I'm going to figure out like why that is, because I
think
forgot.
It's higher or lower?
I don't know. That's a good question. Probably higher, I would say, yeah.
Everyone just uses the 2%, and it's like, who how do we actually know that?
What's funny is, I haven't questioned that a ton, but it makes sense that Bobby brings that up.
So what are your guys' thoughts?
Well, I think it's hilarious that she says, I can make more money selling term insurance than whole life. Bruh. No. I mean,
why do you think she said that?
So there's something I've noticed in the insurance industry, especially if you do what we do as far as building cash value focused policies. We do take a commission hit on those as compared to a permanent life insurance policy with the same premium. So I think some people lean so heavily on, look at me, I'm taking this big hit. I could make more money doing other things, so you should trust me.
Yeah, for example, if you, in a lot of cases, the commission on a term policy is whatever you put in that first year. So if I put in $1,000 on a term policy, the commission would be about $1,000. And the way that we design it is, the premiums are going to be higher. So if you put in $10,000, you're going to get you're not going to get 10,000. Not the way that we design it. You're going to get a percentage of what we call the base, which is low. But in almost every case, you're going to get paid more for permanent life insurance in the first year and ongoing, versus term doesn't really pay you ongoing at all. So it's just, I think you're right. To give her the benefit of the doubt, it's like hey, I make less money, but it's like those kind of things that I go, why do we say that? And I probably said things like that in the past too, because it's just, but it's like, why do we say that? Because it's not true. And Mary, you're welcome to come on. We can discuss it. This is a clip from a long form podcast.
I was just thinking, she may have said she can make more from term because maybe that's her focus, perhaps. maybe she's just doing a ton of volume. I don't know. It's just like
she does great work. She does works with farmers, helps them set up permanent life
Yeah.
insurance policies. She does the infinite banking policy.
Yeah.
She does good work.
Okay.
And
I don't know
she's
a lot
written a
about
couple
her.
books. I would consider her a friend.
Okay, incredible.
She works a
And
lot with One America.
yeah, wonderful company that she's working with. And trust me, she does very well, and good for her because she's providing a ton of value.
Yeah.
But that would be the challenge. I'd be like, could you make more money selling term? Maybe if we're going off of what we talked about of like the commission structure, and if you wrote the same premium that you are doing with permanent. So let's just hypothetically say if you did $1 million of premium over here,
Right.
you're gonna make less money than $1 million a term.
Fair, yeah.
But that's a lot of term insurance, and that's not easy. Like that's
Yeah.
not easy to do.
Yeah.
But to W's point, I think depending on, and I'm not saying this is what she does because we all know she sells whole life, but depending on the business model, right, you could easily make more money selling term insurance because you could sell 10 people term insurance in the same amount of time and energy that would take to do one whole life case. We know it's faster to go through underwriting. We know the expedient, like the easy to explain, the education. There's more people that can get term insurance, so your pool of people is larger. It's easier to service. There's a lot of things that could. I'm not saying that you would, but I'm just saying you could make an argument that these companies online that you are searching, like cheap life insurance, they make a buttload of money for a specific reason because they're able to get lots and lots of people through the door.
Yeah, I guess before you came to BetterWealth, you were slinging
Primary
Slinging
term insurance.
Would you agree with that statement? Because I do think term is straight up easier to sell than whole life, but I think it would be really hard to replace what we make at BetterWealth selling all term.
I mean,
that
we
would
have
just
to change our entire business
entire model,
Yeah,
and it's
yeah.
super competitive.
Right.
And I know because I sold term at the bank, and it's tough, guys. It's just not sexy. It's just like
I mean,
it's like
term almost always comes down to cost for a client.
Yeah, and
so
it's
unless
just-
you're already the cheapest in the industry, it's hard to make a sale unless it's just
and
trust
now
you.
with some of these companies, it's easy. Like you don't have to go underwriting and stuff. But I just remember when I learned the power of whole life insurance and like all the things that, and like when the book came out, I would say that it was actually easier to sell that because people didn't feel like they were getting insurance. They felt like it was almost
Getting
from
an
like a
asset.
selfish standpoint.
Yeah.
They're like, I want this because of the and asset versus it was. So I don't, but maybe I just have PTSD with selling term.
that's
And
true.
so it's like another way to ask this is, what would you rather represent? Would you rather represent permanent whole life insurance, the way that we structure it, or be like hey, we're going to be the cheapest term shop in town? Now we do as a company own convertibleterm.com. So we're a fan of term insurance, but what do we sell more of, term insurance or whole life? I would imagine whole life if you look on a policy.
Yeah, based on my value set, whole life all day. Because like I care not just about the cash value, not just about the death benefit today, but generations to come and my kids and all that sort of stuff.
Now I'm playing devil's advocate for like 10 people right now, but like to her credit though, if you take the big pool of people that are insurance licensed, very few of them can sell permanent life insurance. Even IUL, they can't sell that because it's just difficult.
Sure.
And so it's easier for them to make money at playing term. So I could go all the way around. This is why reactions are great, is like, let's actually have a conversation around these things. And Mary, if you're watching this, we love you. Come on the show. Let's talk. And I definitely can do a deep dive on just some of your books on farming without the banks and all.
Yeah. Something that I'll just say for the conversation around term insurance. If whoever's sold you term insurance sold it with a company that also provides homeowners insurance or auto insurance, you're likely way overpaying for life insurance because it's not what they specialize in. And many, many, many times we have replaced term insurance multiple years after it was sold, and it's still cheaper because it's with an insurance company that sells life insurance, not a company that sells your auto coverage as well.
I'd be curious what I'm sure you're right because I've seen it too. I'd be curious like a larger data set because we have like anecdotal evidence pretty much. I'd be curious what the data would actually say about that too.
We should do a video on return of premium term insurance and the true cost of that because it's astronomical.
I had a guy who debated me, I think it was on one of our YouTube channels, about return of premium and how whole life is a scam, but return of premium. And then what I said, I was like, okay, but return of premium is more expensive than regular term, right? Because it returns. And he's like, yeah, but I'm getting my money back. in 20 years. If we could have whole life break even in year 7,
Get all your money back in your
isn't that return on premium? And he's just like, you can hear it. He's like, oh crap, I talked to the wrong person here. It was just interesting. Let's talk about that.
I didn't think you were gonna think, Caleb.
Yeah, so it's all good.
Good times.
All right,
That's all we had.
final thoughts. I feel like you're sitting on some wisdom.
I am.
That you
I'm waiting
haven't shared
for it.
yet.
I'm good. You know,
Well,
you guys
out of all the videos, we looked at Dave Ramsey, Chris Cron.
I mean, it's very apparent. Like what I already said is just holds true. Like there doesn't need to be more said around it. Like it's very hard for me nowadays to watch and consume the education that's on TikTok, Instagram, YouTube Shorts because of the misinformation that's out there. And I truly believe like it's our mission as BetterWealth to like put our stamp on it and say, hey, we're going to talk about insurance, how insurance actually works. We want to be the Bobby Samuelsons of the world, but be able to do it in a marketing perspective, be able to tell the world and show you don't have to be scammy. You don't have to be able to sleazy. You don't have to ruin it for everybody else to sell products. You can do it ethically, morally, honoring Christ and all that you do to be able to sell these financial products that Dave Ramsey calls scams, or people that are unethical insurance agents that actually do it the right way. So everybody agrees that insurance is a powerful asset for the right person.
Mic drop, baby.
So he was sitting on some wisdom, wasn't he?
Last thing I'll say is if you want to talk to someone like Dom or check out what we're all about, there's links, there's places that you can schedule a call with someone on our team. Dom, thank you. Alden, Demetrius, team, thanks for teeing up these videos.